Here are 3 growth stocks that are currently heavily discounted from recent highs that could represent a great buying opportunity. Do let me know in the comments if you already have any of these stocks in your portfolio or if you're considering adding any soon. I've got my eye on one of these that we're going to talk about later on, but I've not yet added it. Remember, this channel is not financial advice, so make sure you do your own research before investing. If you are considering making any investments, then check out the link in the description below where you'll get some freebies to get you started. The first one up is Enphase. Currently, one share of this company will cost you just over $132. But what you can see is that this stock is actually down by about 61% from all-time highs that were reached this time last year. This company has been hit pretty hard with the macro situation and the interest rate increases. In their Q3 earnings, they reported a 22.5% decline in total revenues compared to the previous quarter, which has undoubtedly put a lot of selling pressure on this position. But is it all doom and gloom? Well, let's firstly understand what they actually do. Enphase is revolutionizing the solar industry with their innovative microinverter technology. Unlike conventional solar inverters, Enphase's microinverters work with each individual solar panel to maximize power conversion. This then means the solar energy systems are made more efficient and more reliable overall. We've just mentioned their poor performance, but actually, this stock has been recovering extremely well and is up over 50% since their earnings. Now, this rebound is partly attributed to the market expectations for interest rate cuts moving into 2024, but also it could be related to the fact that there is boosting demand for solar products. Now let's think about some key metrics. Enphase has shown some really impressive revenue growth over the last few years, which could be, again, a testament to the increase in demand for solar energy solutions. When there is more demand, there is of course more sales. But one key metric that I want to make sure I highlight here is their consistent increase in sales volumes, expanded not just in the US market, but also in international markets. But we'll come back to this in just a bit. Something that any current investors or potential investors should be aware of with this one though, is that Enphase themselves have projected a decline in sales growth in 2024, but they do expect to see more promising numbers in 2025. Of course, this is just predictions. This is not definitely what's going to happen, and a sector like this does tend to be pretty cyclical. Also, the US government are now proposing new rules that could give Enphase and other solar energy companies tax credits for manufacturing their products domestically. And this could help Enphase really increase their manufacturing capacity and profitability, solidifying themselves as a leader in the clean energy space. Let's now think about aligned catalysts and the future for this company. I would say the future looks pretty bright for this company, as they have many promising and strong catalysts aligned in their favor. The first one is just the global shift towards renewable energy sources. And then when you take this and you put it hand in hand with government incentives for solar energy adoption, you start to see the bigger picture. The adoption rate for solar energy in households is still relatively low. It's only 4 to 5% in the US and just over 10% in Europe. Now that may seem really negative when I say that, but actually, this represents a large growth potential. And Enphase is one of those companies positioning themselves perfectly to capitalize on this. The second one is their continuous innovation, like their recent advancements in energy storage and manufacturing systems. And alongside this, their ability and willingness to acquire other companies, which they've been doing quite a lot in order to get to where they want to be. Next up, we have product launches and global expansions. For example, they've recently launched their IQ8 microinverters and IQ energy routers in Switzerland, Austria, Brazil, and other countries. The next catalyst is a little bit unpredictable, but it is important for this sector, and that is elevated oil prices. Of course, when oil prices start rising, this makes solar energy that little bit more attractive to potential consumers. And then we have the macro situation. We've already hinted at this earlier on in the video, but as rates come down, that could indeed favor this company. And lastly, their stock buyback program, which could tell us investors that they have strong confidence in themselves moving forward. However, with any investment, there are potential risks. Enphase faces stiff competition from other companies within this sector that may be offering products for a little bit cheaper. Also, any changes in governmental policies regarding renewable energy could impact their growth trajectory. If we compare Enphase to the S&P 500 index, you can see here that actually over the last 1 month, it has outperformed the market. If we look, however, year to date, significantly underperformed. Let's just expand this to a 5-year period. Fantastic returns to any investors. Similarly, with a 10-year period, it has done way better than the index. I'm looking at this on a website called Seeking Alpha. Personally, I have Seeking Alpha Premium. I use it for all of my investment research. It's absolutely fantastic. I'll leave a link in the description below. Using that link will give you $50 or the equivalent off and a 7-day free trial, just to make sure that you like it before you buy it. The second stock on our list is one that I'm personally starting to consider, and I know a lot of people are as well, and that is SoFi. This is a fintech stock that has been doing very well recently and getting a lot of people's attention. SoFi is a little bit of a weird name, but it actually stands for social finance, and they operate in 3 primary sectors. They have lending, financial services, and a technology platform called Galileo. And their mission is this: to help our members achieve financial independence to realize their ambitions. You can't not get behind a mission like that. The revenue growth year over year on Seeking Alpha is coming out at just over 40%, which is absolutely incredible. And revenue growth forward looking is over 36%. Both of these getting a very strong rating. They've been showing an incredible revenue growth and a strong balance sheet. And even more importantly, maybe, their user base is growing significantly. The more I learn personally, the more appealing this company does become. But I still need to do way more research. Recent quarterly earnings have exceeded expectations, with revenue growing 27% year over year, and they've had a very positive outlook for future earnings too. In this chart here, you can see that they have 137 million Galileo accounts, which are essentially users of their payment processing technology. This vast customer base represents immense cross-selling opportunities for SoFi. And since the acquisition, it's helped to diversify the revenue streams for SoFi and make them way less reliant on their traditional lending products. The macro outlook is going to be really important for a company like this, and if we see the interest rates actually falling, or more importantly, the interest rates not rising anymore, this could be a real positive catalyst for this company. And then student loan refinancing resuming once again. Now, in terms of risk for this particular position, we have to consider competition in the space. The fintech space is a highly competitive market. And this isn't just from other fintech companies either. This is also competition from established traditional banks. So it's really important for us to keep a close eye on whether or not they are maintaining their competitive edge and whether or not they are being truly innovative compared to their peers. Another risk is just that this is a very young company, and at the moment they are an unprofitable company. But this also could represent a massive opportunity to get in early. Let me know what you think about that in the comments below. If we now compare this position to the index, we can see that over the last 1 month, it has significantly outperformed the index. If we expand to year to date again, the returns that it's given investors compared to the S&P have been absolutely insane. Now we expand to a 3-year period, and you can see that actually it's underperformed the index, as it has fallen from those all-time highs. And like I said, it's still a relatively new company. Public company, that is. Lastly, we have Shopify, which started as a relatively simple e-commerce platform, but has actually since rapidly evolved into a comprehensive suite for online business management. It offers tools for everything, from website creation to payment processing to inventory management and much more. Some key metrics to keep a close eye on include their consistent revenue growth, the expansion of their user base, and the increase in transaction volume on their platform. Recently, they have achieved profitability on a GAAP basis for the 2nd consecutive quarter and the 2nd time in their history. This is a really big deal, and this potentially aligns them for future S&P 500 inclusion. I would say that they have several catalysts aligned for growth. The continuation of the shift towards online shopping, the expanding global digital economy, and Shopify's innovation in the e-commerce technology space, just to name a few. They are now shifting their focus on integrating both AI and AR into the shopping experience to position themselves at the forefront of the e-commerce sector. Earlier this year, Shopify exited their logistics business, and this divestment has actually been viewed very favorably by the market. They've been cutting costs across the board, including reducing their workforce by 20% earlier this year. And they've had some pretty notable collaborations, including their integration with Amazon's Buy with Prime option. The risks that I see for Shopify are very similar to the ones that we discussed for the earlier two companies, and that is just the competitive nature of this space. They face very intense competition from giants like Amazon, but also from emerging e-commerce platforms. Could there be market saturation? And also, what are consumers doing post-COVID online in terms of their spending habits, and how could this impact Shopify's growth in the future? Having said that, I think overall the e-commerce sector is experiencing rapid growth and will continue to do so. Comparing it to the index, we can see that overall in the last few years it has rapidly outperformed the index, but what you can also see is that it has experienced times of very harsh volatility. So you may want to consider that before adding this one to your portfolio. With any growth stock like this one, you are going to experience those really fast run-ups, but also you're going to experience those pullbacks that are perhaps way harsher than the average in the index. Now, I'd love to hear your thoughts on all the stocks discussed in this video. Stay tuned for the next video, but until then, keep investing and keep analyzing, and of course, do not forget to hit that subscribe button.